to this new panel. Who should you partner with to navigate your trading desk in a fragmented market structure? So it's an evidence to say that fixed income cash markets are fragmented. And moreover, since they're fragmented in the dark, it's difficult to assess their real level of fragmentation and in how many pools of liquidity the liquidity stands. Now, we all know that MiFID II should change things, not as much as initially expected, because we know there won't be a trading mandate, so there won't be an obligation to trade bonds, on regulated platforms. But still, liquid bonds traded on regulated electronic platforms will be subject to some pre- and post-trade transparency requirements. We're not there yet, but at this stage, it's interesting to study the best ways to successfully source liquidity and how to be as efficient as possible today in the mainly OTC world and in the near future with a range of new models that may emerge from the new regulation. So to discuss these topics, we have today a distinguished panels of representatives from exchanges, platforms, solution providers, and the buy side, of course. And I'm going to ask them to introduce themselves.
Okay, good afternoon, everybody. I'm Lee Sanders. I work for AXA Investment Managers, where I am responsible for FX and money market and responsible for fixed income trading in London and Asia.
My name's Stu Taylor. I'm the CEO of Algomi. We're a vendor that provide essentially information services within the fixed income space.
My name's Jonathan Jachym. I'm head of government relations for CME Group's EMEA office. So I support both our U.S. Market interests in Europe as well as our London-based market infrastructure.
My name is Frank Cerveny. I'm a strategic advisor to the CEO at MTS.
My name is Jean-Philippe. I'm the European manager and work for TradingScreen, a technology provider multi-asset class.
Okay, so to begin with, there are some topics that we love to discuss on and on. So let's start with fragmentation. The fixed income market has always been fragmented. And maybe I'm going to start with Frank. And do you think that the Basel III and MiFID II regulatory reforms have led or are going to lead to an even more fragmented market structure with an increased competition? Or do you think the effect will be more positive?
I think there's a lot of uncertainty. And at the risk of dating myself, I have worked for three great institutions for MTS, Salomon Brothers, Credit Suisse for 19 years, and Jefferies. And during that period of time, since 1985, I have traded, I have sold, and I have managed divisions. And I've seen some pretty scary events and been through a lot of different cycles. But I would say that despite the benign rate environment and low default risks that we seem to be facing right now, I'm more perplexed and more concerned than I think I ever have been. I think there's been a fundamental shift that we are now facing. And I think it's very easy to blame the regulators who are just trying to do their job. It's very easy to say the market is fragmented, which this source of fragmentation has been a great source of profitability, both for the buy side and the sell side. A lot of people like to blame the banks. They did lose some money, but they're providing a very fundamental and necessary role. But I think that what's happened is the combination of all these things has kind of caught the market unprepared. And I think it's the lack of preparation for these second and third order effects that we're now facing, both on the buy side and the sell side. I won't say everyone, because some people have been early adapters, but for the majority of people have put us in this uncertain position.
Okay. Stu, maybe you want to add something?
Sure. I think, I'd echo that. I think fundamentally it's brought into sharp focus, really, particularly for the sell side firms, the role that they provide to the market. And fundamentally, there's two core services. There's been a sort of market making role. Obviously, that has been severely hampered. And those regulations aren't going away. And the other role that banks and the sell side in particular have provided is obviously one of distribution. And really, I think what we've seen and we are continuing to see is a massive rebalancing of the value that the sell side essentially bring to the buy side community as a result of the regulations. And it's an absolutely transformational shift in terms of the business models inside of those firms. I think the fragmentation is also forcing a much deeper thinking about actually how we sort of get business done. Obviously, the concept of warehousing all but the most liquid instruments has sort of fallen away. So we're now thinking about basically everything from not just which instrument am I trading, but is it an instrument that I want to specialize in and maybe will put some capital to work. We're also talking about the size of the trade that I'm doing, and so there's fragmentation occurring across the actual nature of the trade that I'm trying to bring to the market. And so really the whole point is that the services that the banks offer is having to change fundamentally. I think it's, you talked about the competitive aspect of this as well. I think what that's led to, as banks essentially in no small part become brokers, is a real blurring of the lines. And so the roles in the market, again, are changing. So, banks are becoming brokers. That's becoming clearer and clearer. What does that mean for the IDB community? Are they, they're thinking, are the banks stepping into their world? Do they start to develop, agency-type models and start to develop client-facing solutions? We all know certain things that are sort of going on there. You've got the agency brokers who've traditionally carved out maybe more of a niche role for themselves, but now are trying to figure out what does their relationship now mean with the banks. There was a big discussion on that in one of the breakout sessions earlier today. And then you've got the clients, and in certain cases, I mean, most notably, I guess, the BlackRock, I call it experiments, to try and just do all-to-all trading, where clients are saying, well, can we be market makers? I think the market has answered what that should be, which is probably no. But the point is that this blurring of the boundaries, I think, is a real theme. And so that not only are firms individually trying to figure out what they are, I think we're trying to figure out as a market, what does the market structure need to look like as well to keep this thing functioning.
Mm-hmm. Thank you. This is an interesting view for the fixed income. Now, maybe we could also talk about the swaps and futures. Jonathan, what is your view from a swaps and future instruments standpoint?
Yeah, I think the word uncertainty came up earlier, and that's, I think that really describes it. I spent a number of years doing Dodd-Frank implementation before moving to London, and have been working on EMEA, MiFID, and all the different EU regulatory files. And I think from our standpoint, I mean, CME Group's core markets, listed futures exchanges in the US, we've been very successful on the OTC clearing front, particularly in rates, particularly with the buy side seeing some major penetration there versus our competitors. But I think over the last 2 years, the notion of cross-border harmonization, rationalization of what's going on in Europe has become the key topic. And at the moment, we're seeing certain things drive regional preference and product preference. And product preference, we can talk about cost, capital, collateral, Basel III margin, et cetera. But in terms of regional preference, right, we've seen challenges in 4 areas. One with market infrastructure, recognition, equivalence, how are the global markets going to function on a cross-border basis moving forward? Really with CCPs under EMEA, we're going to see it coming up the next 2 years with trading platforms, not just listed futures, but CEFs, MTFs, OTFs in Europe. There's going to be some challenges over the next 2 years under MiFID implementation. But I think more importantly, we've seen it at the clearing member and client level. So at the clearing member level, differences in bankruptcy regimes, presenting major challenges, as well as at the client level, who's a US person, who's not, and how is that going to dictate your regional preference. So open questions in each of those 4 categories. And I think the next 2 years with MiFID implementation is really going to be key to resolve the execution component of reg reform on a cross-border basis.
Okay. So speaking of what's going to happen, or even what has started to happen, there are many different platforms, technologies, market model, newcomers today available, and there will be even more in the coming months and years if we consider all the initiatives that are currently being developed. So my next question will be to Jean-Philippe, and could you tell us what you think would be the right combination of brokers, platforms, and technology that would be necessary to successfully navigate the markets?
Thank you, Nathalie. So, I mean, TradingScreen has been in existence for 14 years. We started in the equity space, and basically what we have seen in all the other asset classes is that the expansion of the number of liquidity pools it's good, it's safe, and it's good to drive competition. Coming back to your question, whether you as the head of the dealing desk on the fixed income side need to choose one platform or another, or if you need to choose one trading model or another. I don't think it is possible to do this at this stage because you don't know which one is going to win, which one is going to lose, and it's very likely that there's going to be more than one platform which is actually going to succeed in this space, maybe having their specificities. So I think the right combination is essentially a platform that allows you to access smart order routers, RFQs, streaming liquidity, dark pools, and everything combined. And as you need that on one screen, one desk, as the buy side is becoming more and more complex, you need the right technology and the right partnership to be able to achieve this.
Mm-hmm. And Stu, do you have complementary?
Yeah, and I think, to sort of build on that, I think, again, and it depends which side of the fence you sit in terms of buy side or sell side maybe, but I think for banks, we see a lot now of basically some of the largest firms really getting to grips with the fact that actually they need very much a holistic approach. The shifting from balance sheet to a distribution model, where there's more of a sort of brokered, albeit match principle type of model through those firms. Fundamentally, that requires a vast array of connectivity internally. It requires to tap into a huge disparate source of information sources, databases, live pricing, new issue, content, exhaust from e-channels, whatever it is. Combine that with the natural market-making capacity. But then on top of that, to layer maybe the human dimension as well. When we're talking about a distribution or a brokered flow, that inevitably involves a person, and it involves the salespeople. So bringing in the relationships that exist between obviously the salespeople and their clients, but then also between the salespeople. So banks are really starting to get to grips with that problem, to make themselves as efficient as possible to get a trade from one side of the firm on a global basis to the other side. Essentially, that's what broking is. And so I think a big part of that is, I say, we talk about connectivity, we talk about execution, but at the heart of it is an information management strategy. And what we're seeing as a vendor who works with a number of banks is the sort of the increasing prominence of that sort of information management sort of thinking. In certain cases, we're seeing information officers who basically take that role. They're not necessarily coming from the IT world. They're actually coming from the trading and sales world, which is exactly where we think they need to come from. So we've got proper business-led thinking now about an information strategy inside the firm. The IT then follows to help join the dots. I think the flip of that from the buy-side point of view is just as banks are becoming brokers, the buy-side are now being brokered. And that brings a brand new dynamic to trading style because, again, we now got a lack of information, you have a lack of trade warehousing, which basically means you have information leakage because people want to try and test the market the other side. If that's done well and it's done succinctly, then you've probably still got a well-functioning market. But if it's done badly, you can really break a market. And so the buy side are having to develop new strategies about how do they enter the market. Obviously, I'm sure Lee can sort of complement this sort of thinking as well. But I think they're absolutely having to think about how do they enter the market in that sort of world, because it is a fundamentally different trading environment to the one that we lived in maybe sort of 5 years ago.
I'd just like to support Stu on this. I think that at MTS/LSE, we're looking at a lot of kind of pre-trade aggregators and initiatives, which I think are important. But I think one of the most important things that you said is that it's got to be business-led. And I think that you need people designing these products that have actually traded or bought or actually done the function so that they actually fit, as opposed to some solution just created by a clever person and try to be forced on the audience.
Yeah, thank you. This is very interesting. So when we talk about navigating the markets, we shouldn't forget that the ultimate goal is to find liquidity. So we know that the dealers who use to hold the majority of inventories cannot do the job of liquidity providers that they used to do now through RFQ systems. And so the next question will be to Lee. And in this current environment, and also maybe in the coming years, where does liquidity come from? Where will liquidity come from? And how do you do to find liquidity? Who are the new providers of liquidity on the market now?
Okay, so let's look at where we are at the moment. The guys have hit the nail on the head, exactly the way the market has changed. I mean, whilst our turnover tables would say that, you know, it's the top 10 banks in our turnover, quite clearly the other side of that liquidity provision, as Stu mentioned, is the buy side, or the end owners of bonds. And the banks are facilitating that liquidity through a somewhat expensive agency model at the moment. So I think everything is now focused on how do we source that liquidity without necessarily that expensive cost. And I think that's going to be the challenge of the next, you know, three or so years, really, and through MiFID and post-MiFID. I think that manifests itself in a few different ways. Do I think we're all going to turn around and all-to-all trade tomorrow? No, I don't. I think it's an evolutionary model, which at the end of the day will end up in an order book and a more organized environment. But through that period, the way that we're going to trade is definitely more around sourcing liquidity and having optionality. There's no right or wrong way at the moment to take on a block trade. The systems which are being developed help the modern trading desk to analyze the best way of executing. In our own firm, our overall head of fixed income execution has developed a series of systems to make it easy for all of the traders to access liquidity, to know where we've found liquidity historically, you know, where our hit rates are, who's best in the sector, and to pull in axes and inventory. But it's quite clear that when we're trading, that a lot of banks are just using our order to potentially facilitate another trade, and they don't really want to run the risk, and you know, for all of the reasons, flogged to death on panels such as this. Going forward, what we're trying to do is navigate ourselves into a position of strength in a changing market environment. Whilst we have had an advantage with our internal systems, we kind of now realize that we've got to be open-minded into the way we're going to trade going forward. Now, looking at the initiative which Stu brings, it's a fantastic idea. You know, looking on larger block trades where you have the propensity to trade that order most efficiently. The thing that I'm more probably interested in on a day-to-day basis is JP's work on an EMS. Now, for us, an EMS is one of the clearest solutions. We can't go with 35 different panels or 35 different platforms. It's just unworkable. So trying to bring everybody connected into one environment and to give a trader optionality for us is the best way. And then, you know, we're not employing the traders that we used to employ. You know, we've recently employed people from investment banks, and you know, sort of getting a bit more smart about how we work with the market and know that we're not being broked. Going back to Stu's point, is very important. So it's changing, but I think, you know, with the EMS, it gives us, you know, liquidity matching, you know, and there's other platforms looking at that which might step outside of an EMS or be in it. RFQ, RFS, dark, lit, order books, and I think down the road, yeah, there will be all-to-all trading, and it'll be a fairer price because, you know, we have to do that to keep the cost down for the end user.
Mm-hmm. And maybe going a little more in detail in the trading process, an additional question on taking into account that most market participants are today connected to a number of different trading platforms or liquidity pools with automated trading processes that have a high level of configuration. How do you think a deal desk should determine the best trading channel on a trade-per-trade basis?
Well, I think the EMS will kind of do that job for you. Mm-hmm. Coming out the other side of the execution is transaction cost analysis, which is a clear indication of the quality of the execution. But I think, you know, trade by trade, I mean, you know, in our firm, every trade is given due consideration. The trader has experience, it has information at their fingertips to determine which channel. We're not going to say, okay, that one's TradeWeb, that one's Market Access, that goes this way, that goes that way. you assess the underlying market environment and make an informed decision.
Mm-hmm.
I just want to make a comment. At MTS, we're not betting on any one type of proprietary software or system. We believe in giving people a choice. But one of the things that we did recently is we bought a company that's been in existence for about 5 years, and we recapitalized them in the last couple of months. And what it is, it's an anonymous all-to-all platform, and it's doing exactly what you say, where just last week we had a very large East Coast buy-side firm connect via an EMS and being able to route their orders directly into the system. And it's in a system where the aggressor pays. So if you just want to provide liquidity, it costs you nothing. And I'm not saying this is going to be the solution, but it's very interesting that a lot of these initiatives are advancing quite quickly.
Maybe just to add to that, I mean, I think in terms of the functionality and how trades are executed, that's one piece we've been looking at just from a U.S. versus European standpoint is the notion of RFQ versus what is an OTF, for example, going to look like in Europe, and even more specifically, the block levels and how is a liquid market defined in Europe versus how certain things have been defined in the U.S. We have CEF block rules in the U.S. that are well defined. There's futures block rules that are ambiguous at the moment. And in Europe, there's an initiative to develop those levels and those definitions of market liquidity and large and scale that I think are really going to define the parameters for execution moving forward. So that's one specific area that not a lot of detail. Details have been sparse ahead of proposals that will be coming out in December, but one area to keep your eye on.
Okay. So going back to the number of new initiatives that are being developed for the time being, maybe a general question on, do you think that the current rush to the new platforms is temporary? Do you think this is going to last? Is there going to be a number of additional new platforms? And do you think that eventually there will be a consolidation? And on which criteria will be the consolidation? Will it be on market models or on targeting different parts of the market?
Yeah, I think you could see fragmentation within the fixed income market on, different systems doing different things. Some ABS, some, financials, and you could break it down that way. I think one thing's for sure, though, Nathalie, I can't see, and where the platforms are at the moment, that the current model is going to survive. You can't come with just one offering. Going forward, you're going to have to bring a lot more, to the trading desk to ensure that your platform is the one that's used on a system. RFQ has been the mainstay of electronic trading. Now, electronic trading is about using the e-space to cleverly navigate your way around where liquidity is, and that's the interesting development which we're looking at. Looking at the work that Stu's doing and the work on Neptune and loads of other people in this space, it's just alerting us where we have the likelihood of writing that business. Now, what does that mean for the platforms? Well, as we've always said, platforms have to innovate, and that innovation is what we need. Not all that innovation will be successful, and will there be consolidation? Yeah, I'm sure there will be. And will there be some people edged out of business? Yeah, I mean, if it doesn't work for them, they'll give up. But at the moment, people are frightened of not backing the winner. So, although we're kind of largely platform agnostic, we're looking at everything and everyone and making sure we're up to speed in the space.
And maybe
maybe if I can add something, technology can help definitively resolve a lot of the problems out there. The challenge will for sure be for the technology vendors to be able to connect to all of these venues and be able to leverage the information. We've talked about this before because now the market is moving rapidly, and what you need to do is you need to analyze a lot more data than you used to have to. In the past, the market was just selecting the right providers on an RFQ platform and just press a button. Now you have to do a lot more work to figure out what happened, what you traded with, and have all this available to you at point of trade. And that's what we really, what we see on the market, and which we see the head of the trading desk trying to figure out, okay, I've seen an axe coming here like last week, and I've traded with this gentleman, at bank A, B, or C, or broker A, B, or C. You need to be able to get all this information available right now at the moment you get the order, or maybe at the moment you get your own clients on the phone, if you're working within the banks. Now the challenge is going to be for the technology providers to be able to go and gather all this information, whether it's internal information within the firm or whether it's outside information, and to be able to access all the various channels. For this, of course, I mean, the FIX protocol has been expanding and developing various ways to make sure that everything is normalized. From my standpoint and from a very selfish standpoint, what we need to make sure is we need to make sure that all these venues and all the platforms use the same protocol so it's easy to plug them in, because at the end of the day, what everybody wants is to be able to connect to the end users, whether you're a bank or broker or buy side. So I think maybe using the FIX protocol sounds like a good idea to make sure everybody's on the same page and share the same information.
That's a key point.
Yeah.
I mean, keeping it all in FIX makes absolute sense. And then, initiatives shouldn't be bothered about, where they syndicate to get their liquidity, whichever it is, whether it's an order book, an RFQ model, an analytics firm. But as far as we're concerned, we can plug in, and everybody can plug into that environment easily to gain access to the information thereafter.
But this doesn't exist today. This is something the industry is working on, standardizing access means and easing the access to all different liquidity pools. So maybe there is another question. Today, with all the different offers, we don't know which are going to succeed, which are not going to succeed. But how choices are made to connect to one and not to connect to another?
But the point is, if everybody speaks the same language, surely, technology should be able to plug into every single of these venues. If everybody speaks a different language, then it's going to be hard. Technology is going to cost, and at the end of the day, the end user is going to pay for it.
So gaining access through your EMS to whichever tool you want.
What you need to do is you need to lower the cost, the integration cost, so that technology can plug in. And at the end of the day, people can trade with each other on an almost normalized fashion. It's good to have all these trading models, but at least let's use the same protocol to talk.
Yeah, it's true that choosing to connect to several platforms can become costly very quickly. And maybe a question on how you are looking at the cost benefits of potential opportunities in Europe or even in the US. Maybe Jonathan, you want to?
Yeah, so I think our US experience, at least from let's use OCC interest rates, open access model, right? So from a clearing standpoint, connectivity to multiple execution venues. I don't think we've seen the fragmentation yet, because I don't think we've seen the market develop yet from a made available to trade determination. Still very small. So those products that are going to be forced into an execution space by a regulatory mandate, I think we have several years before that plays out. And I think U.S. regulators, in light of the difference, the gap between where Europe is from a timing standpoint, are reticent to really move forward aggressively with that until MiFID II comes online next year. So, how this open access model survives and flourishes and what type of consolidation takes place, I think, is going to be something that plays out at least over the next 2 to 3 years as these trading mandates evolve. It was interesting, I think, from the European side of things, multiple execution optionality, right? In the US, for mandated products, you have on exchange or a CEF. In Europe, you're going to have the ability to do a regulated market at MTF, whatever an OTF is, third country markets, depending on how equivalence decisions go. So I think the jury in terms of consolidation still have a long way to go from a planning standpoint. From CME standpoint, we've, again, offered that open access model. We've also launched a CEF initiative in the US. Where that goes, time will tell. But optionality is expensive, so we'll see how things play out over the next 2 years as Europe comes online.
Okay, so the future looks bright.
I think, actually, I'll just add to that as well. I think that there's also a sort of, maybe a slight sort of utopian view, because I mean, the standardized protocol concept, I think, would seem on the face of it to be obvious. I think, though, what it does, though, it actually plays a different thing for different people. And what I mean by that is, if I'm a newcomer to the market, of course, and there's a standard being developed, of course, it would seem obvious to sort of sign up to that, and actually would lower the cost for new platforms to come to market, and that seems like a good thing. But if I'm one of the big incumbents in the market, and I've got maybe some existing connectivity, it's not so obvious to me that I actually want to standardize myself to allow these new incumbents in. So I think, in one sense, it's a great idea. I think in other senses, though, what you may see is that the guys who've got the market share today will make very different commercial decisions, and just because that they can. And I think that is so. There's almost a reality check to, I think, some of these ideas, because unfortunately we're not living in some utility sort of world. Everybody here works for a commercial enterprise with very real revenue and profit targets, and market share and market structure is a big debate, and has been a big debate of these sort of forums for the last 5 or 6 years. And tools like connectivity are very strategic enablers, or at the same time they're also very strategic barriers to entry if I'm trying to keep somebody else out. And so, whilst I think it's on the face of it, it's easy to be supportive of these ideas, and I think we would as well from the Algomi perspective. But if I just think it depends on the perspective.
I think the banks have still got the ground as well, and,
Yes.
and that works perfectly. What we're saying is we absolutely like that model. We want to trade with banks. We want to have an efficient pricing system delivered to us from a bank. And part of the work that I've been involved in is empowering banks, making sure that they advertise to us. And Jan started that for us years ago, and we're continuing that work. If they advertise, they give us their inventory, we'll write those tickets. What we're saying is that when that doesn't work, that's when we need the alternatives. Sure. And there shouldn't be barriers to people coming into that space if the banks have let it go.
Yeah, that makes sense, I think. Makes sense.
Okay, maybe we can also talk about a recurring topic, which is best execution. So yeah, I know we talk about this every panel, but it's still an issue, because obviously finding liquidity is great, but then the next objective is to have access to best execution. So, and we know that in a fragmented market, it's difficult to achieve. So, how do you think a dealing desk should address best execution in this current landscape, which is very fragmented? And also, how do you consider what do you consider is best execution? Is it just calling a few banks, or is it more than that? And how can it be addressed? So maybe starting with Lee, and after...
Lee jealous of that guy who just walked out there. Okay. Yeah. It's a really interesting subject. I mean, I was on a round table today with our peers talking about this subject, and there's no right or wrong answer, and there's no end game which says, yes, that was best execution. Mm-hmm. In the fixed income market, we're in a world which is very different to the equity space, and it's kind of very similar to the FX space. What we do is we put the right people in the right spaces to do the right job. The compliance department would look at a trade and said, did you ask 3 people and hit the best of those 3 prices? Therefore, that's best X. Everybody in this room knows that's not best execution or even best selection. Going forward, what we're doing in our firm is documenting everything on a trade-by-trade basis and trying to prove that we made the right decision if we're challenged at all by the regulator or by a compliance division. And we've even got our own department set up within TSF to go through that with us. Looking at a fragmented market, it probably comes a little bit easier to put a trade together, and quite clearly you'll see, if you've got quite a good view of the market, that you've done the job in a reasonable way. Where I think it's called a bit more into question is on the block trades. Why did you select that particular counterparty, or how did you work that order? Do you think that was the right level? Where does it kind of get measured? Well, coming out the other side through transaction cost analysis, which I think everybody is keen to see how that space develops. So, yet again, transaction cost analysis isn't necessarily a proxy for best execution or even best selection. So I think it's an unsure space, and people are just doing everything they can to make sure that they are heading in the right direction. Whether there's something a little bit more rigid coming down the line for us remains to be seen. But I know going forward, the regulators are going to be continually looking at what is best X.
Mm-hmm. Stu, maybe you want to add?
Yeah, no, I'd agree with everything Lee just said. I think, from our perspective, we see it really as systematic process. If we talk about the easy part of best X in fixed income, I mean, right now, I guess many buy side would say, well, we check 3 prices and therefore that's best X. But if you just stop to think about what you've done, if I've checked 3 prices, what it means I haven't checked maybe a big chunk of the rest of the market. So have I really got best execution? What you've actually done, though, and the reason why that works, is it's a systematic process. And you can evidence that I've gone through a systematic process. And so when my compliance team checks on me as a dealing desk manager, we did the right process. And hopefully we'll put some pricing context around that, et cetera, et cetera. I think the same can be done with the larger sizes as well. I think that's something I think we certainly at Algomi we are pioneering here as well. But about introducing a systematic process approach to some of the larger block trades. There is no such thing as perfect proof that I've got the best price, short of checking everybody. But clearly you're not going to do that for lots of market disruption reasons. So it's just about systematic process. And I think as long as you put arrangements in place to do that, then I think you get some way towards satisfying the regulators.
So it means that it's going to be very difficult if the regulators wanted to regulate best execution and to define a very precise, to give a very precise definition. It would be impossible to
and I don't think they will. I mean, they already regulate best execution today, but what they haven't done is been prescriptive in terms of... So the 3-price rule is not something the regulators came up with. It's something that has evolved in the industry as a response to a call for systematic process, I think. And I'd be very surprised if the regulator said, you've got to do it this way. Short of a CEF-style model where you're essentially putting it onto some venue, and we say if it works, if it's trading on a regulated environment like that, then it's best X.
It's too complex to be modelized. So.
Potentially. Yeah. So I think we'll see a variety of flavors, but with a theme of a process around them.
Okay. Okay, so maybe one last question, and I'd like to have the views of all the panel. Looking at the title of our panel, navigate our trading desk in a fragmented market structure. How do you see the market in, let's say, 2-3 years after MiFID implementation? Do you think less fragmented? We know that maybe there's going to be a little bit more fragmentation at the beginning because of all the new initiatives and after a consolidation. But globally, how do you see the market? Will it be less fragmented? If we meet in 2 or 3 years, we will still have the same panel, or will it be a different one? I don't know if you want, Frank, if you want to start.
My bet is that it will start to consolidate, and we'll see winners. I think that particularly with respect to the credit market, because it's so complex, it's taken a while to find a solution. But I think if Google can design driverless cars, we can come up with trading systems that work, right? And I think take that analogy a little bit further. If you wanted to try to start an online retailer today or a social network, you'd struggle against the big powerhouses. So I think what's going to happen is that the best ideas out of the 30 or 40 or how many names there are out here will succeed, right? The ones that are not backed by prominent institutions or deep pockets will probably struggle. And I just think that's kind of an economic reality. In terms of which one will win out, I'm not sure. That's why we're taking, we're trying to be very, very pro-partnership with a number of different initiatives. A lot of things that we have today, fixed protocol, pre-trade analysis, click-to-trade, RFQ, central limit order book, we embrace all these things. But at the bottom of all this is my concern. And I think the analogy here is we're all sitting in this crowded room, and let's imagine a fire breaks out, okay? But there's only one exit, it's right there, okay? Now, I may be old, but I'm close enough to that door, I think I'm going to make it, right? But my concern is about my heavier friend over there, or the guy with the big, that's you, Gab, or the guy in the back who's got that big portfolio of bearer bonds. He may not squeeze through that one exit, which is either the voice model or the RFQ model, right? So I think right now, when we're facing this world of potential shocks, the exogenous shocks that we may face, we need to at least entertain all the various solutions, not only at this panel, but what we've been hearing throughout the day.
Thank you. Jean-Philippe, you want to give your views?
I think it's a big question. I mean, will people win? Will people lose? Of course. I think there's a clear trend, and there's also a lot of movements in the whole in the industry, whether it's in the US or in Europe. There's a clear drive, and that's coming from the regulators. That's coming from regulators worldwide. In fact, finally talking, basically are changing the rules globally at the same time. Maybe 1 or 2 years, one after each other, but regulators are pushing. Technology is pooling. I think the buy side is getting organized. The banks are restructuring as well. There's going to be losers. There's going to be winners. I think from banks and buy side, I think you need to be able to work with a wide range of platforms. Sorry, and that's the story, right?
Jonathan?
I think in times of stress, market uncertainty, market flocks to liquidity. And so we talked a lot about new liquidity. We've seen from CME Group and our interest rate complex just this last month, phenomenal activity, right? And so I think what we see is that that basic core vanilla interest rate futures product tends to really experience a lot of growth. Now, in terms of other platform execution, yes, there's pretty significant difference in terms of timing, also in terms of substance. Just over the last year, I think the fragmentation we've seen in the rate space, and ISDA has done a number of studies on this, right? Looking at where euro-dollar liquidity's gone versus more U.S.-centric products. I think until regulators rationalize execution and some of these clearing member and client level rules, that's going to persist, and we're really not going to see a clear direction.
Okay. And maybe Stu?
I mean, I think I would guess some level of consolidation. I mean, there's a sheer number of new platforms springing up every week now. It's almost comical, and so I would guess it's almost inevitable that we get some consolidation for sure. But I think we are, for the first time, really starting to look at the whole liquidity spectrum in a very meaningful way. The fact that we've got so much innovation across all the platforms, I think, is very, very encouraging, because I think just maybe a few of those will actually break through and do something that's really transformational in markets that we've not cracked, maybe so far. But really, it's I also echo the points about the organisations that win will be the ones that are backed by the major organisations, and they will be the ones that are heavily bankrolled as well, because this is a tough global market to crack, and it does need significant resources to do so. So I think some of maybe the small startups that come together, where we've got a couple of displaced trading heads deciding they're going to set up a new platform of whatever sort, maybe need to think about how they're going to tackle these problems, because these are long, multi-year solutions that we're going to evolve to. Yeah. We're not going to suddenly splash bang solve the problem, I don't think.
Maybe Lee, a final word before we open the floor to questions.
What was the timeline? 3 years, 4 years?
Yeah.
I think it
Let's say 3 years, yeah. Let's say
3.
1 year after the implementation of MiFID II.
I think I agree with the guys. I think there's going to be a certain amount of consolidation, but I think there's going to be a lot of flux on the buy side on how they execute their business. And I think that's going to be the quite interesting dynamic. We love the optionality, but with too much choice becomes too much indecision at times. I also think that it's going to be very different from the larger asset managers to the smaller asset managers. I think the smaller asset managers look like they're getting forced out of the space a little bit in the execution piece. What I do think we're going to see somehow and manifest itself in some ways a more organised buy side. Everyone's talking about it. It's something that we're pushing for. So I think we need to be liquidity makers as well. We can't just keep on taking liquidity from these initiatives. We have to work on how we supply liquidity to banks and they take their liquidity. I personally think that a lot of these initiatives will make the banks more efficient. And it's something that I believe in, that when you work in a firm like ours, banks want to channel, their liquidity to certain places, and obviously we're lucky enough to be in one of those positions. And I think the more efficient way that they'll use their balance sheet could be a benefit for us in the long term. So, how we work in that new market environment, banks, giving us risk prices or how they unwind that risk is going to be key as well.
Okay, so looks like quite positive outcome.
Hopefully.
Yeah, hopefully. Maybe we can open the floor to questions.
Hi. I think it's probably more a question to you, Lee, actually. It's buy-side correlation. If you look at Europe, I think it has some structural differences to the US, where it's a very clustered buy-side. And I'd like to know your viewpoints as to, from my perspective, a lot of buy-side clients run similar model-driven portfolios, similar indexation. So when one is a seller, they're all a seller. So with all this talk about providing a new liquidity venue, when rates go up 100 basis points and credit spreads blow out 250 basis points, those top 10 asset managers are all selling. So who is providing that liquidity in an all-to-all market? And I think this is maybe one question no one's really addressed. Yeah. I feel more comfortable with the US because it's a deeper, broader market. But I think in Europe, it's a very closed room. So I'd love to get your viewpoint on that.
Great question. I mean, I was talking about this last night with some guys from Market Access. And it's a very interesting subject because before you would have had a more orderly, kind of more orderly chart on how people would exit the trade. So if credit spreads were too tight and, was invariably the buy signal for the insurance groups. But then we always moved as a herd, and the way that worked quite clearly was banks carrying a large inventory. What I think you're going to see going forward is not that orderly unwind of risk. You're going to see, we'll take the phones for you chart, you'll see adjustments like that where asset classes become attractive for entrants again. So you will see quite clearly very nasty price action and rebalancing where either people want to own it or they don't want to own it. So if yields back all the way up, people are come back into the trade. But you're quite right. No one's going to take up that middle ground, such as it will fulfill the role that the banks played. Nobody can warehouse the risk. That said, lots of different people are operating different market strategies as well. New players in the space, I think, could weather some of that. There's a lot of money still coming in. The great rotation hasn't really occurred, and we might see a more organised sort of retracement back to the old kind of levels for yields. But it could be chaos, you're quite right.
Okay, do we have time for another question? Just one last question? Or no question? Okay, well, I guess we can thank our panelists. And thank you.